Hello, this is Professor Hazara again. This is the last video in and for international accounting. This is the one on uh, restating financial statements, the remeasurement method. Okay, now I've already identified two methods. One is translation. I just did that example in the previous video. Now I'm going to do, in this example, we're going to do remeasurement. Now, remeasurement is a little more complicated because here's the rules for remeasurement. Current rates are used for, here's the method right here. Current rates are used for monetary items, historical rates are used for non-monetary items. So you use two different rates. You may be thinking, what's so hard about that? The problem is that historical rates, by definition, those are the rates that existed when you purchased something, when you took some debt out, whatever, when the transaction took place. The problem with that is that, let's say you bought 1,000 different assets. That means you would have to look at 1,000 different rates. Now think of Walmart. Walmart has billions of different items, so you have to look at billions of different things. So that's why companies like to use translation. Although some do use measurement, and there's, generally speaking, for really big corporations, it's a mixture of the two. But the preference is for translation because it's cheaper and easier. Okay, and the other thing is, we're going to have, just like we did in translation, we just did the translation example. We'll have the worksheet. We had a plug here, translation adjustment of 12,780. Here we're going to have a remeasurement loss, and that loss is going to be smaller because it only applies, it's not cumulative, it only applies to this year's income. So it's going to be part of this year's income, and it's going to be only applied to this year's income. Okay, so let's go ahead and get this started here. And what I'm going to do, just like the last one, I'm going to identify the rates that you would use for different items. Okay, now cash and accounts receivable, those are monetary assets. So we're going to use the rates that existed and you bought the other, excuse me, what I'm saying, those your monetary items current rates. So the current year is, the current date is 12/31/X4. You acquired the company at 12/31/X3, exactly a year ago. So the current rate is the rate at 12/31/X4, and we will use the same rate for, excuse me, we'll use the same rate for accounts receivable. Let's get this over with. Let's go down here to accounts payable. That's monetary liability, and notes payable. You can use the current rate there too. Okay, inventory. Let's see what it says. It gives you a bunch of information about inventory here. Now this would be their ending inventory, and then they give you some information here on their ending inventory and purchases. Okay, their ending inventory is composed entirely of purchases made throughout the last quarter of X3 when the exchange rate was 53 cents. So that, in essence, would be kind of considered a historic rate when you bought the stuff. It's, remember, inventory is non-monetary. Okay, and then it also says that the beginning inventory, the 12/31/X3 beginning inventory, I'm reading writing here, of Australian dollars 40,000 was acquired in 19X3 when the exchange rate was 50 cents. Okay, um, so let's go see what we're going to do here. So I have a little cost of goods sold calculation down here, which is going to be beginning inventory plus purchases, gives you a goods available for sale, take out the inventory, it's going to give you a cost of goods sold. Well, the beginning inventory, the rate we're going to use for beginning inventory, they give you one rate of 50 cents, but that was before you acquired the other company. It makes sense that the historic rate for any asset that the other company owned when you acquired the other company was the same, was the same rate at the date on which you acquired the other company. So a company has a bunch of assets and you acquire that company, that's the date on which you acquired those assets. So we're going to use here for beginning inventory, we're going to use the rate that existed at 12/31 X4, which I believe was X3, excuse me, which is 49 cents. So we'll use 12/31 X3. And it says because the company already owned it. Now, for purchases, it says right there 53 cents. This is going to be average rate uh, last quarter X3, I think it says. X4. Okay, and we'll just go ahead and run this. Okay, so we got that. And I'm going from here, right there. It says And if your composite purchases made uniformly throughout the year, when the exchange rate was, okay, so the beginning inventory was acquired at 50 cents, but you acquired the other company when the rate was 49 cents. So we'll use 49 cents there. The purchases were made uniformly throughout the last quarter when the exchange rate was 53 cents. And then the ending inventory of 42,000, we're going to use the ending inventory should also be the last quarter, because it depends where you're thinking, LIFO, FIFO, whatever. We'll use the last quarter of X4. Okay, we're assuming we have some layers there, so I guess we're assuming LIFO inventory. Okay, and so this inventory here, the inventory on the balance sheet, we're also going to use, it's basically the same inventory that we have down here. So we'll move this up to here. Let's also notice that both 42,000, well, the current inventory is 42,000. Now we've got plant and equipment is a non-monetary item. So we've got to decide what was the exchange rate that existed when plant and equipment were acquired. Now it says here, this is tricky. It says plant equipment were acquired in X1 when the exchange rate was 47 cents. The problem is that was before you bought the other company. You bought the company at the end of X3 when the exchange rate was 43 cents. So we're going to use 1231 X3 for that. And that's because the exchange rate, when you bought the other company, you essentially bought the equipment at that date. So that's your exchange rate. And we're also going to use the exchange rate for all things depreciation expense. That makes sense because our depreciable cost is 100,000 for plant equipment based on whatever exchange rate existed 1231 X3. So those have to be consistent. Now, all equity items. All equity items are going to be, like I did in translation, equity items are done at the historic rate. So we already know from the previous problem, dividends are 51 cents. So this is 730 or 731, whatever the date was, 730 X4 is when dividends were paid. So we'll use that rate then. And our cost of sales, we'll do a little calculation down here for cost of sales, so we'll get that. And then other expenses, all we've got left is allowance for doubtful accounts. Now the allowance for doubtful accounts, it just makes sense that you're going to use whatever rate you use for accounts receivable for allowance for doubtful accounts. That's a negative contra monetary in a sense. And then you've got two equity items. The equity items will be the historic rate at 1231 X3. And we'll use the same thing for retained earnings. Then the only thing we've got besides cost of goods sold are other expenses and sales, which are sales here. Use the average for X4, so we'll use average X4 rate because you earn them evenly throughout the year. Average X4 rate, and you could argue that's average historic or current rate, whatever it is. I mean, it's what happened in the year. Okay, and then actually we should move this down here. And now our cost of sales are going to use, I'm going to put various rates. Use various rates for that one. Okay, and the various are these down here. We'll do our cost of sales calculation here. Okay, so let's go ahead. Let's do the cost of sales calculation first. We'll put it in, and then we'll go ahead and finish our financial statements, our trial balance. Okay, so the rate at 1231 X3 was right here, 49 cents, so 0.49. That's that's the rate that existed when you purchased the inventory, and it says it's a historic rate. It says. Now purchases were purchased on the average for X4, which is 0.54. We'll use 0.54 for purchases, which were evenly throughout the year, and inventory we'll assume came out of those purchases. So last day it's a FIFO thing. So excuse me, what it would be? Yeah, it would be LIFO. Yeah, it's first FIFO thing. First in, first out. Okay, so let's go ahead and multiply these out and get a number for our inventory here. I know it's going to come out. I'll have to add it back. Okay, so that plus that plus that. Okay, so end up with cost of goods sold of 40 plus purchases. I'm going to do that. That makes a lot more sense. Okay, so our goods available sale was 19.6 plus 28.80. Is it? So cost of goods sold is 40. Our goods available sold is 47.68, 680, and then less our ending inventory is going to be our cost of goods sold are going to be 25,000. So we've got a subtotal there and a subtotal there, and we'll bring up our cost of goods sold from the calculation right there. Okay, next is we've got our rates here. We've got our rates. Let's get all the rates in. 1231 X4 is the current rate. The current rate we already know is 58 cents, which is right there. That's 0.58. And we'll go ahead and get these rates copied in here. Those are all the current, are all the monetary items right there. Inventory average last quarter is going to be equal to, well, it's got to be equal to this number right here because that's your ending inventory. Okay, your plant equipment was acquired, date was 12/31/3 because that's when you acquired the other company. They already own the plant equipment. So that's going to be restated at 47 cents. Your plant equipment, 12/31/3, 41, I was saying 49 cents. 49 cents on equipment. And so let's go ahead. Anything that says 12/31/3, let's get that down. Well, depreciation, that's the only expense you use the historic rate for, but you got to be consistent with your depreciation base there. We're going to use historic rate for those items there. A historic rate for dividends too. Now, dividends were paid on July 30th, 1984 for 51 cents. This is 0.51. And cost sales, I'll just put various here. These are various again. Okay, and it seems like everything except for the average rate. Okay, and the average rate for X4, we're going to apply that to other expenses because that was the, expenses that occurred average throughout the year. Let's say it's an average historic rate now. And 54, it's both current and historic. Okay, so that's what we got here. I think I've got all my rates here. Okay, so notice that for the monetary items, for these monetary items here, we use the 58 cents. There's monetary items there. 3 monetary items there. For inventory, which is non-monetary, we actually use all historical rates in this calculation down here. For inventory, use the historic rate. Average of last year, which was 54 cents, last quarter of X4, which just a minute, it was 53 cents. I'm reading from right here, by the way. There where the pointer is. I should have made that 53. And this should be 53 also. It should be. I'm just looking at this purchase. Average for the last quarter. Purchases. Okay, now wait a minute. No, I'm going to change one thing here. It says, okay, purchase of inventory totaling 52,000 were acquired uniformly throughout 19X4, not the last quarter. So the average, this is the correct rate, but this is the average for, this is average 19X4. So it looks like the rates are correct here. Cash, 58, and opened out there. Inventory, that's the last quarter of X4. That's what it says right here, 53 cents. Plant equipment, 49 cents when you acquired the other company. Dividends, that's when you paid them, 51 cents. Depreciation expense, same as equipment. Other expenses is the average, 54, including purchases were made evenly throughout the year. Okay. And formula throughout the 19x4. And then we come down here. These are all monetary, 58 cents. That's the current rate. That's good. Common stock and a retained earnings, the historic rate when you acquire the company and sales. So everything looks good. Okay, so we'll go ahead and multiply all these out here. And we'll stop those right there. We'll just leave that at 0. And then we will multiply this out here too. Okay, and I'm just going to go ahead. Yeah, obviously I have a worksheet. I'm going to check it out here. 10,440, 17,400, 49,000, 6 and 48.6 looks good. Okay, so our total on the credit side is $146,200. Okay, and I'm going to go ahead and just is equal to the sum of these things here. 1,20480 seems a little low. Cost of sales obviously was understated there. 24, 3920, 5400. Okay, so we're good. We're good here. Okay, so obviously the plug is very easy to calculate, but I'm going to go ahead and just do what I usually do, which is take the opposite side and subtract out the sum of the side you want to plug on. And that should give you the rather small plug for this one, $300. That's your small plug here. So it balances out 146.2 on either side. And notice how small the plug is. It only applies to this year's income. You close it to this year's income statement, by the way. Okay, so let's go ahead and start with financial statements. Okay, sales is 48,600 minus cost of goods sold. Cost of goods sold is, we plugged it right. Take it from the schedule. I'd rather take it from the, I don't know why. There, so your gross profit is 23,180, and we'll underline that. Okay, so your gross margin is 23,180. Take out our fuel expenses we have here. We're going to do this is equal to negative depreciation expense minus 3920 minus other expenses minus 5,400. Your remeasurement loss. Now, I want to emphasize that in this case, that your remeasurement loss is so small, and it applies to this year and goes to income. So our net income is 2380 plus that negative plus that negative plus your small remeasurement loss. Your final income is 13,560. So now we can bring that down to our statement of retained earnings. Okay, and our beginning retained earnings are 1960 plus net income minus dividends. Your dividends are minus 5,100. So we're going to get 19.6 plus that minus your dividends. Your ending retained earnings are 28,060, which we'll just bring down to our ending balance sheet. And now we'll just bring all the assets down and balance down. That's the liabilities down and balance them out. Okay, your cash, 23.2. Accounts receivable, 11.6. I'm going to bring that over here and get the net realizable value here. This. Okay, your allowance should be at the very top there, minus 1160. So your net realizable value for accounts receivable, X, that number, 10,440. Your inventory, you can just take it from here, but I like to take it from the balance sheet, the trial balance, excuse me. It's 22,260. Your plant and equipment. I guess that's plant and equipment net. Your plant and equipment is 49,000. So your total assets is the sum of these numbers here. It doesn't look right. Coming out as negative. I don't know how that negative got there. 104,900 looks good. Then we'll just finish this thing up, and we've got accounts payable is equal to 10,440. Notes payable is equal to 17,400. Common stock is equal to 49,000, and our total. 104,900. So we total there. So we're good on the totals, 104,900, 104,900. Let's change just a couple points, and I've got to make sure I don't lose all my computer space here. Let's change this to dollars. These are US dollars again. You just use a different method. Okay, so it's the currency. It's the US dollar. So these are US dollars, not Australian dollars. So you took Australian dollars once again. You took Australian dollars. These are Australian dollars. So you took Australian dollars and you changed them to US dollars here, using the rates. And then you brought these US dollars down here and you made them into financial statements. The financial statements are in US dollars. This is as of 12/31/4. Okay, so everything looks okay here. Couple things. I'm just going to quickly compare this sheet. First of all, 2 points. Number one is right here. Over here, you valued plant equipment at 49,000. In the translation, you value plant equipment at 58,000. I'll tell you right now, that 49,000 means more because you're taking the historic rate, the historic cost, times your historic rate. You essentially bought it at 12/31/3, and you're getting 49,000. So that gives you a good measurement of historic cost. So theoretically, this method is better from that view. The other thing is, and I've already said this, remeasurement loss here. Let's put this in red. Remeasurement loss here is only 300, and as part of net income, it goes into your own consolidated net income eventually when you consolidate. Over here, you had something that goes to OCI, and I said it, but I'm going to say it again. This plug goes to OCI because it's cumulative, and basically it's just a balancing number. It doesn't mean anything, whereas it's plug number. Whereas over here, the remeasurement loss does mean something. It's part of income. These are the statements. Theoretically, these are the same statements that you would get if your foreign sales office, because they're a sales office in this case, they're not a separate foreign manufacturing. They're a sales office, as if the foreign sales office actually operated in the United States. Theoretically, that's what you should get. Okay. Anyway, so this method, once again, it's theoretically correct because you're using current rates for monetary items and non-current rates for historic items. However, the problem is when you have to use historical rates here, you have to use historical rates. If you have millions of historic items that you bought at the time, it can create a problem for companies. You'll notice that companies do have a preference for translation because it's simple, cheap, and it's, and accountants will go with it sometimes because the cost is not worth the benefit, and the benefit actually gets lost because this whole concept was made in FCFS. I think it was 80. I don't know, but when it came out like 1986 in there, I think it was SFS 84, 73, 84, something like that. The old FASB statement, and it's old. Stuff is old. And the world economy was different. You had a very set supply chain. U.S. had more exporters, all that stuff. So in a sense, and these concepts are used both in U.S. GAAP and IFRS. So that's why, I mean, in a sense, you could say, well, let's use remeasurement because it's more accurate, theoretically. But if it's so complicated in real life that it doesn't represent reality and doesn't really give you a lot of benefit. If the benefit isn't there because it's so complicated, it just creates a big mess. Just use translation. And then the analyst can figure out from there which they need to do. Anyway, I'll put this video up, and that'll be it.